Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
Valens Semiconductor, ticker VLN, just gave us one of the most explosive pictures in the microcap space I've seen in a while. On January 9th, 2026, the stock surged, what was it, about 26.6% in a single session, to settle near $1.98.
Right. But what made that move really stand out wasn't just the price action, it was the mechanics underneath. We saw, 4.7 million shares trade hands? That's over 5 times the average volume. And then you had that just wild, almost 2,700% increase in call option volume.
Exactly. And that kind of activity, it's the classic signature of a gamma event, where market makers are just forced to buy the stock to hedge their short call positions. It creates a mechanical squeeze. But, these transient market events, they just sharpen the fundamental question for us.
Which is, does this surge signal a genuine re-rating of the company based on, real fundamental strength and maybe some strategic shifts? Or is it just temporary noise that's masking some really deep structural business challenges and, frankly, some pretty serious competitive headwinds?
My position is that the market is presenting a deeply asymmetric opportunity here. I think Valens' substantial, $93.5 million cash position, and its already validated MIP A-Fi technology establish a profound margin of safety. This is, to me, a classic deep value play with massive potential for rapid appreciation because the market is assigning a near negligible value to world-class defensible IP.
And I'm going to argue that low valuation is entirely rational. In fact, it's justified. I think it's a function of persistent unprofitability, significant execution risk that's just inherent in the automotive sector, and the overwhelming competitive threat from the automotive Ethernet ecosystem. Until they demonstrate real mass-market revenue and scale, the risk of a long, painful capital drain is just too high.
Well, let's start with the balance sheet, because when you look closely, the deep value thesis is, I think, very compelling. Valens has a market cap right now of roughly $202 million. Crucially, as I said, the balance sheet holds $93.5 million in cash and zero debt. This is not a complex financial structure. So if you just subtract the cash from the market cap, you are left with an enterprise value of only about $109 million assigned to the entire operating business. I mean, the IP, the design wins, all the engineering talent for $109 million.
That EV number does jump out, I agree. But I come at it from a completely different direction. The market is pricing VLN as a melting ice cube for a reason. And that reason is persistent unprofitability and stagnant revenue. Q3 2025 revenue was only $17.3 million. So while you emphasize those high gross margins, and they are high, consistently around 66–67%, those margins are for now theoretical, without volume scale. If the market saw that $93.5 million in cash as a true floor, the stock just wouldn't be trading at these levels. Investors are applying a massive discount because they see the high R&D spend continuing for years without any guaranteed returns.
But that discount completely ignores the quality and the validation of the intellectual property. That 66–67% gross margin is not theoretical. It signals a high-value, defensible product that is extremely difficult to replicate. And more than that, the technology is actively being validated in the most demanding parts of the market. We just saw confirmation of a fourth major automotive design win, including a premium OEM specifically for the vast Chinese market. That reinforces the viability of the MIP A-Fi standard. This isn't theoretical product development. These are real production commitments for 2027.
Real production commitments that are still years away. And that brings us to the existential risk here, which is the Betamax scenario. Look, MIP A-Fi is technically superior in some ways. For instance, its ability to run on lighter, cheaper, unshielded twisted pair, or UTP cable for 15 meters. That's a real physical advantage. However, as we all know, technical superiority doesn't always win the standards war. The cheaper, more ubiquitous, and frankly heavily pushed ecosystem of automotive Ethernet, spearheaded by giants like Marvell and Broadcom's, could just defeat A-Fi simply through standardization and scale, which would completely cap Valens' total addressable market.
Okay, but let me interject on a key catalyst here before we dive deeper into that tech war. The appointment of Yoram Salinger as the new CEO. That is a critical strategic signal. This is a person who has 2 previous successful technology company exits under his belt, Red Bend and Perception Point. This signals a clear mandate not just for organic growth, but for M&A or strategic repositioning. With that clean balance sheet, Salinger is perfectly positioned to pursue an acquisition premium, which, historically runs 6 to 8 times sales for high-margin chip IP firms like this.
The M&A thesis is inherently speculative, though. It depends entirely on external parties. My fundamental concern remains the cash clock. We established a cash runway of about 6.6 years, based on a trailing 12 months cash burn of about $14 million. Now that sounds long, but the entire investment thesis hinges on those 2027 startup production, or SOP dates. If the notoriously conservative automotive industry delays those SOPs, pushing revenue out to 2028 or even 2029, that cash buffer is going to be significantly depleted, and that's going to force them into dilutive fundraising at these already depressed valuations.
So let's start with the integrity of that cash floor. That 6.6-year cash runway is an exceptional margin of safety. It makes this a near net-net thesis where the downside is structurally mitigated by the balance sheet. They have a capital runway to navigate the valley of death until 2027 revenue recognition without immediate shareholder dilution. This fundamentally changes the risk profile compared to almost any other microcap semiconductor firm out there that's dependent on constant capital infusions.
That certainty of capital is interesting, but it makes me wonder, what exactly is that cash costing investors? The $14 million annual burn rate is a certainty, so we have to focus on the opportunity cost and the time value of money here. That $93.5 million cash reserve is constantly shrinking in real terms, while investors wait for a thesis that is entirely dependent on future execution. That cash is not static. Any delay in the 2027 SOP, and we know execution risk is just endemic in automotive design cycles, it immediately brings up the necessity for capital markets intervention, which rapidly erodes that perceived valuation floor. The market is pricing in this timeline uncertainty. That's why the EV is so low.
That balance sheet stability is precisely what enables the strategic optionality, which I think is what's being undervalued. The lack of debt and the high cash balance make the company extremely attractive to a strategic acquirer, say a massive player like NVIDIA or Mobileye. It simplifies due diligence immensely. A buyer is acquiring pure proprietary IP without the headache of refinancing or immediate capital calls. That cash floor isn't just a shield against dilution, it's a foundation for demanding an acquisition premium, because the buyer doesn't have to finance the transition period.
I'm still hesitant to rely on M&A, which is an external factor when the internal clock is ticking and competitive risks are just mounting. So let's pivot to the technology landscape, because that's where the revenue will either appear or evaporate. I maintain the industry standard is moving irreversibly towards zonal architectures built on symmetric, packet-based Ethernet, where players like Marvell and Broadcom, they dominate the entire data pipeline. A-PHY's asymmetric design and its point-to-point focus, while technically elegant for certain lengths like a unidirectional camera feed to a processor, it limits its application to high-end, dedicated niches. And that fails to achieve the necessary scale to justify the extensive R&D expenses they're currently burning through.
I hear you on the risk of industry standardization, but for the safety-critical high-speed camera-to-processor links, which is the non-negotiable killer app in advanced driver assistance systems, or ADAS, A-PHY's advantages are more than theoretical. They are physical and economic. Its low latency is crucial for real-time safety systems, and more importantly, its ability to use lighter, cheaper unshielded cables, UTP, over distances up to 15 meters provides a tangible return on investment for OEMs.
Okay, but why is that cable advantage so crucial?
Because Ethernet, which runs the rest of the car network, traditionally requires much heavier shielded cabling, STP, to manage electromagnetic interference in the harsh automotive environment. STP is more expensive, and it adds significant weight, and every ounce counts in EV performance. So A-PHY solves this connection problem with a lighter, cheaper standard cable, while maintaining speed and integrity. On top of that, A-PHY is the open standard, That mitigates the vendor lock-in risk inherent in proprietary SerDes solutions, which are basically competing closed-off data lanes, like TI's FPD link or ADI's GMSL. Open standards are what OEMs ultimately want for supply chain flexibility.
That is a compelling argument for the technical merit. I'll grant you that. But technical superiority does not always translate to market victory. This feels like a classic standards war. Is Valens going to be the technically superior but ultimately niche Blu-ray, or is the cheaper, good enough BHS of automotive Ethernet going to win the volume because Tier 1 suppliers prioritize standardization for overall supply chain simplicity? I mean, standardization is often driven by economies of scale and simplicity, not just the physics of one single camera link. If Ethernet can get close enough on performance at a massive volume discount, that's the winner.
But if APHI is genuinely indispensable for the highest performance, safety-critical links, and the 4 OEM design wins suggest it is, then it secures a non-negotiable beachhead. Those margins confirm the pricing power of that IP. So let's go back to the valuation. Because even acknowledging those competitive risks, the current pricing implies an irrational discount, especially when you compare them to their peers.
Right, let's talk about peers, because that is where the market gets nervous.
The market is valuing VLN at approximately 1.5 times enterprise value to sales. If the company were merely re-rated to parity with its closest growth peer in this space, Indie Semiconductor, ticker INDI, which trades closer to 4 times EV to sales, well, the implied target price would be around $3.65 a share. That move alone more than doubles the stock price. And the CEO transition, again, confirms the move toward monetization, whether it's through organic scaling or M&A.
I'm just not convinced by that line of reasoning, because the peer comparison is complex and I think often misleading. Indie Semiconductor commands that high valuation multiple for very specific reasons. Its broader platform approach encompassing power management, LiDAR, radar solutions, and crucially, its established, faster revenue growth. Valens, as we've discussed, has a primary single product focus, which is connectivity, and until that revenue hockey stick actually materializes post-2027, the superior gross margin profile of 67% compared to Indie's, 49 to 50%, is just irrelevant due to low stagnant volume.
A company like Valens with high gross margins and low volume is exactly what private equity or strategic tech buyers look for. They see the lever they can pull. They can immediately cut operating expenses and scale the IP across a massive sales force, realizing the full value of that 67% margin. The current valuation suggests the market believes Valens will burn through all $93 million and fail to capture any significant revenue. I just think that outcome is severely mispriced.
Perhaps, but the trading environment suggests structural pessimism, not just misplaced fear. We started this discussion by noting that temporary gamma events spike, but you have to consider the trading friction. The daily short volume ratios are consistently high, often running between 40 and 50%. Now, while the official short interest is low, around 1%, that high daily short volume ratio means market makers are actively hedging their inventory and their liquidity provision. And that structural hedging is what structurally suppresses price breakouts, despite the low valuation. It confirms that sophisticated institutional players are managing risk against VLN's volatility, not buying the long-term thesis.
That just confirms that market makers are managing the options flow triggered by speculative volume, not fundamentally countering the thesis. The options volume surge itself, whether it's retail or institutional, confirms that investors are positioning for a strategic event, a mandated re-rating, or an acquisition, because the low enterprise value makes it an irresistible target.
And I see institutional players using high-frequency trading and derivatives to monetize the volatility inherent in the stock with high execution risk and a long timeline, ensuring that any temporary upward pressure is capped by sophisticated hedging.
So, to summarize my position, VLN is fundamentally cheap. It's structurally protected by $93.5 million in cash, and it's technically validated by 4 OEM design wins. The market is effectively buying an option on the future success of world-class automotive IP for less than the current liquidation value of the business assets. The combination of the new CEO's M&A experience and the high margins makes us a prime candidate for a strategic exit and a massive upside re-rating.
And I maintain that the current valuation accurately reflects the high uncertainty tied to that 2027 SOP timeline and the existential competitive threat from the vast incumbent Ethernet ecosystem. Until demonstrable revenue growth accelerates and the company demonstrates the scale needed to actually use that 67% gross margin, the low valuation is rational. The capital will continue to burn, reducing the valuation floor, while investors wait for a market victory that is far from guaranteed.
This dichotomy, deep value protected by an immense balance sheet versus the substantial execution and competitive risk, it perfectly illuminates the core complexity in microcap tech investing. You have certainty of capital against the high uncertainty of the revenue timeline.
Right. The outcome truly hinges not solely on the technical superiority of the AFI technology, but on the successful translation of that validated IP into mass market revenue, before the cash flow is breached by unavoidable industry delays and the competitive landscape shifts entirely to the Ethernet standard. It's really a high-stakes, multi-year race against the clock.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.